Silver has outperformed gold in the current bull market. And I say bull market because I think we're still very much at the early stages of that. Um, so obviously on the industrial side, it's a possibility that the demand will slide a little bit at the higher prices, but that's counteracted by the investor demand, which now wants to buy silver. Now, the Silver Institute is forecasting that investors will.
Think about this for a second. What if the most common, boring metal, silver, is actually the real story signaling a massive shift in global monetary strategy?
Something strange is definitely happening when you look at silver's recent performance. It just defies the normal gravitational pull of the financial markets.
How so?
Well, for decades, silver was, predictable. It moved when industry moved. But now it's acting like an emergency reserve asset.
Okay, let's unpack that signal. We're doing a deep exploration of the insights from macro strategist Clive Thompson. And his thesis is incredibly compelling.
It really is.
The market event that really brought this into focus was that recent margin shock out of Japan.
Yeah.
You had this massive unwinding of leveraged positions, stocks, bonds, crypto.
Yeah, everything considered a risk-on asset was just tumbling violently.
And when a high-leverage event like that hits, the typical response is, what, systemic deleveraging?
Exactly. Every asset should drop because funds need cash, right? They sell whatever is liquid.
But that's not what happened here.
Not at all. And that was the surprise. While the rest of the market convulsed and, traditional risk assets took a heavy hit, silver stood out.
It actually strengthened.
It's strengthened. And Thompson argues this is definitive proof. Silver is no longer purely an industrial commodity. It is now behaving like a monetary safe haven.
Wow. And if that premise holds up, that silver has basically remonetized itself in the eyes of big players,
then we are not nearing the end of some speculative run.
we're in the early phase.
The extremely early phase of a new multi-year cycle. This isn't just about a few retail investors buying coins. I mean, this is about central banks, massive sovereign wealth funds.
Serious institutional capital.
Yes, repositioning for a world that looks fundamentally different from the one we've lived in for the last 50 years.
So that underlying shift is the core mission of this deep dive. Understanding the forces driving this hidden accumulation and determining why silver, specifically, presents such an asymmetric opportunity right now.
Exactly. The upside is just.
Right.
It's potentially huge.
Okay, before we go further, make sure to hit subscribe and support CredEdge. So to start, let's ground ourselves with a current snapshot. As of November 25, 2025, gold is holding remarkably strong.
Near record levels. Trading around, $4,090 to $4,120 an ounce.
That's an incredible high floor to establish.
It is, and that stability at these levels, it really speaks volumes about who is buying and why. But if gold is the base,
Silver is testing the limits.
that's a great way to put it. Silver is consolidating, hanging in that critical $49 to $50 range, though it has pushed decisively into the low $50 a few times recently.
And why is that $50 number so important? Is it just a round number, a psychological thing?
It's both. It's psychological and it's technical. I mean, $50 was the peak in 1980.
And again in 2011.
Exactly. It carries heavy historical weight. So if silver decisively clears that level and holds it, say, it moves into the mid-50s and just sits there.
It's a signal.
It's a massive signal to a huge tranche of technical traders and institutional funds that decades of resistance have finally broken. Thompson suggests that crossing that barrier could unlock a wave of new, momentum-driven buying.
Which would just accelerate the whole cycle.
Absolutely. The fact that silver is consolidating so tightly near 50 right now tells you exactly what the smart money is doing.
They're accumulating quietly.
Accumulating quietly before the definitive breakout.
Okay, let's get into the mechanics of this accumulation. Here's the twist, right? The current high prices for gold, this weird resilience in silver, it's not being driven by the masses.
No, not at all. Not the everyday investors chasing headlines. It's being driven by a quiet, strategic shift by sovereign actors.
That is the crucial insight here.
It's everything. The key drivers are central banks, and their motivation is fundamentally different from a typical investor's.
They're not looking for a quarterly return.
No, they are not buying to sell for a profit next year. They're buying gold because they need a robust plan B, which does not involve the dollar.
So they're buying geopolitical insurance.
Precisely. And that means they are price insensitive. If the price of gold goes up $200 tomorrow, They truly do not care.
They just keep buying.
They just keep buying. They aren't trying to time the market. They're trying to de-risk their reserve holdings structurally. And when you have a buyer of that scale and purpose,
Yeah.
they create a rock-solid floor under the price.
And we have actual evidence of this coordinated buying, too.
We do.
The World Gold Council did a survey recently, and it indicated that a staggering 75% of central banks plan to continue increasing their gold holdings this year and next.
75%, that's not a market rumor, that's official intent.
But intent is one thing.
Execution and transparency are another. And this brings up a major point Thompson raises, the reporting lag. It creates incredible information asymmetry in the market.
What do you mean by that?
Well, many central banks, particularly in the East, they either don't report their purchases promptly or they use a long intentional delay.
So how far behind are the official numbers?
Months. The aggregated, officially reported stats are often months out of date. I mean, we might only have global numbers finalized up to, say, early June, even though we're sitting here in late November.
So you can't rely on that data for real-time analysis.
You can't. What it means is that sophisticated analysts and hedge funds know the official numbers are just a fraction of the actual gold being moved.
So if the official stats are basically useless for tracking what's happening now, how do analysts like Thompson figure it out?
They look for proxy data, they track trade flows, they analyze these massive unexplained movements of physical metal from hubs like Switzerland and the UK.
And they look for anomalies.
Exactly. Structural anomalies in the reserve reporting of key countries. They're trying to forecast true accumulation despite the poor official data.
And that search for proxies leads directly to the biggest candidate for this kind of covert, price-insensitive buying.
China.
Thompson suggests there are three strong interlocking pillars of evidence pointing toward a massive secret accumulation campaign.
Right, a campaign designed to minimize political friction.
So let's start with the first pillar, internal production.
Okay. China is a gold powerhouse. They produce about 20% of the world's gold from their own domestic mines.
20%. That's a huge volume. Where does it all go?
Historically, a portion would be reported, some would go into the domestic jewelry market. But the thesis here is that instead of reporting it, they're channeling a significant portion of this internally mined gold directly into secret, unreported strategic reserves.
So they dig it up, and it just vanishes.
It vanishes into the sovereign vault system without leaving a paper trail visible to the World Gold Council or the IMF.
So they're using domestic supply to hedge against the dollar without making big, splashy international purchases that would, as Thompson put it, raise American eyebrows.
Exactly. It's a clean way to de-dollarize on the sly.
Okay, so that's pillar one. What's the second?
The second pillar involves the specific type of gold bar being moved internationally. This is a technical detail, but it speaks volumes.
We're talking about the 400-ounce bars.
We are. We've seen large quantities of these 400-ounce bars being exported from European hubs, refined in Switzerland and London, and shipped directly to China.
And why does the size matter so much?
Because the Shanghai Exchange, the main consumer market, it trades in smaller units, 1 ounce, 3 ounce, 1 kilo bars. The jewelry industry, even smaller.
So who uses the 400-ounce bar?
Central banks. The 400-ounce bar is the London Good Delivery Standard. It is the specific, standardized bar used almost exclusively by central banks for massive, long-term storage and settlement.
It's the institutional standard.
It is. So when you see massive quantities of that specific size consistently heading to a single sovereign nation, the buyer is almost certainly a central bank. It's not retail, it's reserve building.
Got it. That makes the movement of the metal itself a signal. So we have hidden domestic gold and international transfers of central bank-specific bars. What's the third piece of evidence?
The third piece is what Thompson calls the plateaued reserves anomaly. And this is where the macro picture really clicks into place. It's probably the most compelling evidence of all.
Okay, lay it out for us.
It connects their trade policy to their monetary policy. Since about 2014, China's official reserves, the total liquid holdings they report, so treasury bonds, official gold, and special drawing rights.
Wait, pause there. Most people know treasuries and gold. What are special drawing rights, SDRs?
Right. SDRs are an international reserve asset created by the IMF. They're not a currency, but they're a claim on a basket of leading currencies: dollar, euro, renminbi, yen, pound.
So it's another way to diversify away from just holding dollars.
Exactly, part of the de-dollarization toolkit.
Okay, so China's total reported reserves, treasuries, gold, SDRs, have stayed flat since 2014. Why is that an anomaly?
Because for decades before 2014, there was a strict correlation. Rising trade surpluses always meant rising official reserves. If China made an extra $500 billion through its export machine?
Their reserves grew by $500 billion.
Roughly, yes. But since 2014, their annual trade and current account surpluses have continued to climb massively every single year.
They're earning more dollars than ever.
Absolutely. The surpluses are huge and persistent, yet the reported reserves have remained oddly flat.
So the implication is the money is going somewhere.
The money is going somewhere. It strongly implies China is still building up reserves, maybe at a historic pace, but they are simply not reporting the accumulation in the official figures.
Then why not?
Geopolitics. Thompson suggests that reporting the true rapid extent of their de-dollarization would hack off the Americans and potentially invite some kind of retaliation.
Okay, so just to sum this part up, the current high gold price is being driven by a major strategic actor who is price insensitive, building reserves for a non-dollar future, and actively trying to hide what they're doing.
That's the summary. And that brings us to the Western retail disconnect.
Right.
Now, think about this paradox. If central banks are piling in, preparing for systemic risk, what are ordinary investors in the West doing?
They're selling.
They're net sellers. Precisely. As gold prices peak, Western retail investors have been pulling money out of gold ETFs, liquidating positions, and chasing momentum.
In tech stocks and crypto?
Yep, high risk, high beta assets, which means the upward movement in gold is clearly being driven by strategic actors, sovereign funds, big hedge funds, the smart money.
Not the masses.
And that is a fundamentally critical bullish indicator for the long-term cycle. Bull markets historically end when the masses are fully involved.
Right, the classic taxi driver tip indicator.
Exactly. When your dentist is bragging about mining stocks. If retail is selling safe haven assets to buy the latest AI darling, we are very, very far from the end of the cycle.
It provides incredible perspective on scale, doesn't it?
Oh, absolutely. Thompson made a brilliant point on scale. He said the market cap of a single dominant tech company like NVIDIA could currently buy the entire global gold mining sector.
The whole thing.
All the companies, all the assets, all the infrastructure, 4 times over. So if even a tiny fraction of that capital chasing tech decides to rotate into hard assets, the shares would just go through the roof.
Because the sector is so small by comparison.
It's tiny. The momentum is in tech, but the value and strategic positioning are in metals. And it just shows how early we are, despite the already high price.
Indeed. Sovereign money's moving, but that truly massive wave of private institutional money,
The private banks, the pension funds,
they haven't even really started yet.
not even close.
If this perspective feels useful, take a second to subscribe to CredEdge. It genuinely pushes us to keep bringing more research stories like this based on deep analysis. Okay, let's pivot to that future waves of demand, the institutional money. You said it's moving slowly, but Thompson is certain it's moving.
He is, and the slow movement isn't due to skepticism, it's due to bureaucracy. This is the institutional logjam, and understanding it explains the timeline for the next phase.
This is the part people outside of massive banks don't get, right?
They completely misunderstand it. People assume a chief investment officer just decides, let's allocate 5% to gold, and then clicks a button.
And it's done.
It's not. Moving from zero to a meaningful allocation in an asset like physical gold is incredibly complex. It's a multi-year, multi-departmental gauntlet.
So let's walk through that gauntlet. The CIO makes the strategic call. Where does it go first?
It immediately hits the legal and compliance department. This is where the logjam starts. They have to ensure that adding this asset, in whatever form, is legal under the rules of every jurisdiction they operate in.
For every type of client they serve.
Exactly. That's a massive headache. Take Europe. A lot of pension funds or specialized insurance policies have mandates that prohibit holding physical gold.
So they have to sort out all those exceptions first.
All of them. And get sign-offs from regulators across multiple continents. This alone can take months.
Okay, so once the lawyers are finally happy, what's next?
Then you need the exposure department or the risk department. Their job is to decide how to gain exposure.
And they have a lot of options.
A ton. Do we buy physical metal, which means vaulting and fees? Do we use an ETF, which is liquid but has its own costs? Do we go through the miners for leverage? Structured products. It's a complex trade-off between cost, liquidity, and counterparty risk.
And they have to worry about moving the market, right? A big fund can't just drop $1 billion order.
No way. They have to ensure the market can absorb their allocation size without slippage. So they might decide to acquire it slowly, over 12 months, to layer in their exposure discreetly.
Okay, so they've decided what and how. Then they have to figure out where to put it.
And that brings in the custody department. This is where the difference between paper assets and physical assets is just stark.
How so?
When you buy standard shares in the U.S., they go into the DTC, the Depository Trust Company. It's a digital ledger. It's seamless, standardized, cheap.
But physical gold is different.
A whole different ballgame. You need extensive sub-custody agreements. The custody team has to secure agreements with every vault operator, every counterparty, often across different countries. They have to verify documentation, agree on auditing. It's a month of negotiations.
And even after all that internal work is done, it has to go back up the chain.
Correct. It goes to the full investment committee for final approval. And because this is a fundamental change in asset allocation, a move that challenges the idea that fiat currencies are stable.
Senior management has to be involved.
The CEO, the board, they all have to sign off. And finally, the client-facing side has to assess whether their high-net-worth clients will even approve this new strategy.
Wow. So Thompson's timeline suggests this whole complex process started mid-year.
And banks are now rushing to finalize all these agreements.
For what?
So that gold and silver allocations can be officially included and executed according to their 2026 asset allocation tables.
So the real tide wave of private institutional money, it hasn't even begun to flow yet.
Not yet. It's delayed by the sheer inertia and bureaucracy of these major institutions.
But doesn't that create a risk? If it takes them 18 months to shift strategy, couldn't they miss the move?
That's a fair question. For smaller funds, maybe. But Thompson is arguing that because the driver is structural de-dollarization, massive debt, this is a multi-year trend. The institutional money won't catch the first 100% rise.
But they'll catch the next 300%.
And their entry will provide the fuel for that continuation. Their slowness validates the early positioning of people already in the market.
Okay, this part is easy to miss, but it changes everything when you look at silver's positioning. Gold is the insurance, the plan B. But silver is where the asymmetric upside is.
That's because silver strength is fueled by two massive structural demand forces aligning perfectly.
You have the investment demand we just talked about.
And you have an industrial demand profile that is just exploding.
Let's get into that industrial demand. We're talking about massive global changes that depend on silver.
Absolutely. Silver is the most electrically conductive metal on the planet. You simply cannot build the infrastructure of the future without it.
Like what?
Electrification. So electric vehicles, smart grids, massive solar build-outs, and critically, the AI revolution. Data centers require huge server farms, and those servers require tons of silver for conductivity and heat management.
And solar is a relentless consumer of silver.
Relentless. Photovoltaic cells are highly silver intensive, and even though they're getting more efficient, the sheer volume of global solar installation is just overwhelming those small savings.
So you have that relentless industrial demand, and at the same time you have investment demand rising from the exact same concerns driving gold.
Exactly. Global debt, currency debasement, de-dollarization.
When you put those two together.
The supply crunch becomes crystal clear. The World Silver Institute forecasts that global investment demand could surpass 200 million ounces in 2025.
200 million ounces. How much is that in context?
Well, let's break it down. Spread globally, that's roughly 1 single ounce of investment silver for every 45 people on the planet.
Okay.
Now, consider that most of the world doesn't have disposable income for metals. So if even a small percentage of the public, say the top 5% of investors, decides to buy multiple ounces, 5, 10, 20 ounces.
Supply simply cannot stretch.
It can't. And unlike gold, where a lot of it exists in vaults, silver gets consumed. It's in your old phone, your circuit board, it's used up.
And mining output is inelastic.
Notoriously inelastic. You can't just flip a switch and dig twice as much. It takes a decade to bring a new silver mine online.
So if investment demand suddenly jumps to, say, 400 million ounces,
the mines can't meet that. The only way you meet it is with recycled silver. And the only way you get massive amounts of recycled silver to enter the market is to have a price that's significantly higher than it was yesterday.
And that's the explosive upside potential.
That's it. Gold is heavy insurance. Silver is the leveraged bet on the future.
Okay, let's move from the physical metal to the miners. Thompson concludes that gold and silver shares are massively undervalued right now.
Yes, because the market is failing to factor in the current $4,000 plus gold price, let alone a future price.
It's a classic case of market lag. So let's walk through his valuation formula for these companies.
Okay, step 1. You estimate future production, say, for 2027. This is expressed as gold equivalent ounces, or GEOs, which combines all their metal production into one figure.
Step 2. Apply an estimated future gold price. Thompson uses a conservative $5,000 an ounce.
Step 3. Subtract the all-in sustaining cost, or AISC. That's the cost to get an ounce of gold out of the ground and to market. Adjust it for inflation.
That gives you the gross profit per ounce.
Right. Then step 4, subtract all other expenses taxes, corporate overhead, prospecting. That gets you to the company's net profit.
Step 5. Divide net profit by the number of shares to get earnings per share, or EPS.
And the final step is applying a PE multiple. Thompson suggests 10x for miners, which is conservative because they deal with finite resources. They can't command the high multiples of tech companies.
And the result of this sober calculation is that the projected future price for these shares is often what?
Using a $4,000, $5,000 gold price in its current calculation.
They're lagging significantly.
And the core reason for this disconnect is the leveraged effect on profits.
Right. Let's use that simple multiplier example again.
Okay, imagine a miner. Their cost, their AISC, is $2,000 an ounce. If they sell gold at $3,000 an ounce, their profit is $1,000 per ounce. Simple enough. Now, suppose the gold price rises by 33% from $3,000 to $4,000. Their cost stays relatively static at $2,000.
So now their profit is $2,000 an ounce.
Exactly. The gold price rose 33%, but their profit per ounce doubled, a 100% rise in profit.
That is the power of leverage.
It is. Every additional dollar the metal price rises goes straight to the bottom line. And most investors are still valuing these miners based on the sub-$3,000 gold price from a year and a half ago.
They haven't factored in the new reality.
Not at all. And that's the opportunity.
For context, did Thompson offer any insight on other commodities, like copper or uranium?
He did. On copper, he hears a strongly bullish long-term consensus. Electrification, data centers, it's all going to drive demand. But he has a caution.
Which is?
Copper is still highly susceptible to economic slowdowns. Dr. Copper. Right. If the world economy sneezes, copper gets pneumonia. So his suggested strategy is to buy gradually over 6 to 12 months to account for that volatility.
And uranium.
He looked at it a couple of years back and found the mining companies to be massively overpriced, in his opinion. The shares had gotten way ahead of themselves. He avoided them then, and his focus remains firmly on the metals where the value disconnect is most pronounced.
Gold and silver.
Gold and silver.
Okay, let's bring this all home. Let's summarize the strategic landscape based on Clive Thompson's deep dive.
The signal is undeniable. Strategic sovereign actors are quietly but aggressively preparing for a new monetary era centered on de-dollarization. Gold is their insurance.
And the timeline, while slow, is fixed. The true institutional money, that massive wave, is navigating a bureaucratic logjam, but it is inevitable. They are targeting 2026 for their allocations. The buying hasn't even started yet.
And Thompson's final conclusion is succinct and potent. Gold is the insurance you must hold for stability. Silver is the asymmetric upside opportunity.
Because of that perfect storm of industrial investment demand against a tight supply.
Exactly.
So how do you see it? Drop your thoughts in the comments. We base this entire exploration on the detailed analysis by Mr. Clive Thompson in his video on the Macro Edge channel.
And the provocative question we leave you with is this. Thompson argues we are still in the early phase of a multi-year cycle. Are you positioning yourself early, using this unique window while bureaucracy delays the big players? Or are you waiting until the crowd wakes up and prices already reflect that inevitable institutional positioning?
If you haven't subscribed yet, join CredEdge so you don't miss the next insight. Stay alert, stay strategic, and stay ahead.